Hi friends, let's start this video on a positive note. Have a look at my screen and you will see that between December 2021 and September 24, small cap stocks have delivered much better earning per share, 62% growth in the last 2.5 years versus large cap stocks that have delivered 30% earnings per share growth. And as a result of this growth, what has actually happened is that a lot of money has gone into small cap stocks, and we can see that in this data point here where the AUM of small cap mutual funds have gone very close to the large cap mutual funds. Because naturally when the earnings growth is there in the small cap stocks, money is likely to flow there, and that's what precisely has happened here. But at the same time, what has actually happened here is that there has been an overflow of money into small cap. And if you remember 6 to 8 months back, SEBI came out with a statement that there is a froth in the small cap space. Also, RBI indicated that there is a froth or the valuation concerns in the small cap stocks. And as a result, within hours and few days, the small cap stocks started to crash and tumble like anything, and a lot of retail investors started to lose money in small cap stocks. In fact, in the last 6 to 8 months, if you have lost any money in small cap stocks, please let me know in the comments, because it's a realization for you as well that where is your portfolio taking the biggest hit. So is it small cap stocks, which stock, and what sort of bad decisions you might have made? Let me know in the comments. I would love to read your comments. Pause this video, share your experience about small cap stock investing in the comments, because in this video, what I'm going to do is, in this video, I'm going to teach you how to differentiate a bad quality small cap stocks and a good quality small cap stocks. This type of content not many people are able to create, because here I am practically going to share examples of stocks and what to look out for in small cap investing. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. Like this video, let me know in the comments a simple thank you. Also, if you want to practically learn stock investing, personal finance, mutual funds, ETF, etc., consider joining my YouTube member community, because I share very insightful, exclusive content for my members almost on a daily basis. You're going to learn a lot. The feedback of this community has been excellent. Simply go to my channel, press on the join button, or you will find the link in the comments. With that, let's go to check number 1 that we must do if you're picking up any small cap stocks. So the first check that we need to do is how much is the institutional stake held in that particular small cap stock. So have a look at my screen. We are going to take a practical example. What do you see here? That between December 21 to almost March 2023, if you look at the FI stakes, or if you look at the DI stakes, they are almost non-existent stakes by FIs and DIs. And if I show you the price chart between the same period, which is December 2021 and March 2023, if you look at this data here, so Jan 2022 or December 2021, almost if you go and up to March 2023 here, you will see that the stock has not moved at all. This was absolutely the bad time to invest in this particular stock. Why? Because FIs and DIs did not have any stakes in the small cap stocks. And the reason to buy a stock when FIs and DIs have the stake is because FIs and DIs do a lot of due diligence. They do a lot of vetting about the management of the company, about the structure of the company, a lot of things about company that you as a retail investor either will not have time or will not have the expertise to do. Therefore, please make sure before you invest in any small cap stock, there is some level of FIs and DIs stake in that. Now, again, I'm going to expand this example and show you what exactly happened here. So now if I come back to this and show you that in the month of June 2023, first time FIs picked up 3.47% stake in this particular stock. And as soon as that happened, you see the stock prices started to go back up because FIs started to buy the stake and the company started to getting noticed in the market. Now, if I show you between September 2023 and September 2024, the last 1 year, not only FI stakes have gone up, but also the DIs started to buy that. Now the total stakes you see is almost 13%, 8 plus 5, 13% of stakes have been owned by the FIs or DIs. As a result, if you see the stock prices have gone like crazy here. Again, I'm not giving you the name of the stock because it does not really matter what stock chart we are looking at. What really matters is the core concept. And I'm using this as an example to drive home important point here. And the point is that when the FIs or DIs have held almost 5%, 6% of the stake in a small cap stock, that is the sweet spot to try and analyze that particular company from various other prospects. But that's already a very, very good big tick about that stock, that there is a lot of vetting that has happened. And also, if you want to buy a stock when the FIs and DIs have got already 20% of stake, then the question is that this has already gone up. right? So the sweet spot is not when you have FIs and DIs stake at like 20%. Sweet spot is when you have around 5 to 6% of buying done by FIs and DIs. And also the most important point you need to understand is that you need to look for the reputed FIs and DIs, because nowadays there are a lot of shell companies being opened, offshore companies being opened. You have to make sure that you're looking at those FIs and DIs name that are reputed. And what you can do is simply look at the FI name and the DI name, go and do Google about it, read about the FIs and DIs. That itself will do some automatically ticks on that particular company. Of course, we will do our own research. I'll also talk about few other checks as a minimum we need to do, but this one check is a good starting point in my view. If you like this point, hit the like button. Let me know in the comments a simple thank you while I move to the next point. Now comes the second extremely important check, which is debt to equity ratio, which is also called the leverage risk. Have a look at my screen and you will see 7 small cap companies here. None of these are recommendations, but the point here is that if you look at their debt to equity ratio here, lower the debt to equity ratio is, better the quality of the company is. I'll come back to these 7 companies in a minute, but I really want us to understand the concept first. So have a look at my screen. You will see here that this data was as of December 2021, but that doesn't really matter for the core concept I want you to learn here. What you note here is that 35 small companies in the last 10 years as of December 2021 got either acquired or got delisted. So the mortality rate of small cap company is relatively higher than the small cap or the mid cap. And one of the key reason is higher leverage risk or the higher debt. Because if a small cap company has taken a lot of debt, what is likely to happen? Their interest payment is going to be really high. And when the interest payment is higher, their profitability will come down. They will have less cash generated with the business. They will not be able to expand. So if I were to pick from 2 companies which are growing at the same earning rates, but the debt to equity is lower in one of them, then I'll go with that. Now, how to go about checking debt to equity ratio? Very simple. Have a look at this screen now. 7 small cap companies. One thing that we need to make sure is that these companies should be of the equal size in terms of market cap. So for example, all these companies are between 7,000 to 10,000 crores of market cap. So similar size. Why does the size matter here? Because the companies like Reliance or Adani, they can afford to have, for example, higher leverage risk. They are the big corporates. But when you are comparing debt to equity ratio, please make sure you are comparing apple to apple, not apple to oranges. So the market cap is of the similar range. So that's what I've done here. Second important thing is I've seen people comparing debt to equity ratio of one company from one sector and second company from second sector. No, please don't do that. Debt to equity ratio profile will change from sector to sector. So make sure that you're checking within the same sector. So for example, all these companies are into the energy sector, and that is where you go and check the debt to equity ratio. Now again, it's not that you just check the debt to equity ratio. There are a lot of checks. So for example, we talked about the FIs, DIs. The second check is the debt to equity ratio. Now let me move to the check number 3. The third check is the quality of the management. Extremely important point when it comes to small cap stocks, because if a fraud is committed by the management, then in small cap companies sometimes it may go unnoticed, while in case of large cap companies things come out very clearly in the public domain. We know examples of large cap companies. I'm not going to stress on those, but I want you to learn quality of management from 2 recent practical examples that you need to know. Number 1 is MapMyIndia. You might be knowing what has happened, but let me give you 30-second summary here, that the company operates in 3 segments. One is B2B, second is B2C, third is B2B2C. Again, I'm not going to explain all these 3 to you, but the point is that their CEO, Rohan Verma, all of a sudden announces that we are going to create a new child company, and this B2C division I am going to take with me. Now the question is that who is going to own the new child company? The management said that the 10% ownership will remain with the parent company, while the 90% ownership will go to Rohan Verma, the CEO. And also the parent company will have to subscribe to 35 crores worth of CCDs. It's like a funding that the parent company will need to do to the child company. So on one hand, you are taking funding of 35 crore from the parent company, putting it to the child company, but when it comes to ownership, you're only giving 10% to the parent company, meaning the existing shareholders of the parent company is only going to get 10% equity share in the child company, while they have been investing in the parent company for I don't know how many number of years. So this was the problem here, where the interest of shareholders was not kept in the mind. Of course, later on when the investors started to shout about it, the company had to reverse their decision of 35 crores of funding by the parent company. But again, the question is that did the management think about the right interest of the shareholders? Of course not. And therefore, would you invest in a company like this no matter how good the quality of the assets is the question that you need to ask yourself. The second example is Mistan Foods. Again, you might be aware what has happened very recently. Everything was cooked up in terms of the customers. So fake customers, fake suppliers, fake invoices, fake revenues. This being almost like 8,000 to 9,000 crores of market cap. I think that's a very small cap company. Allegedly, the management and promoters committed the fraud. I don't know how true is that. SEBI is investing in it. The time will tell us whether who is right and who is wrong. But the point is that the integrity of the management is the crucial aspect. Now you may say that, Rahul, we don't know in future who is going to commit fraud. I absolutely agree. We do not know who is going to commit fraud in the future. But the point here is that at least when you're picking up a small cap stock, please read the history of the management. You are likely to get some red flags if there are any. And secondly, there is also a concept of related party transactions. Again, please read up about related party transactions. If I explain related party transactions in this video is going to get really wrong. I don't want to do that. I really want you to take this as a homework and read up about related party transactions, and how to do these checks is what you need to learn at your end. So far, if you're with me, request you to hit the like button, and also please subscribe to this channel. I don't generally speak enough about subscribing to this channel, but if you're learning, please subscribe to this channel. You are going to learn a lot in the future as well. Now coming back to check number 4, extremely important check, which is that if you are picking a small cap stock, please make sure that the sales growth and the profitability growth of that small cap stock is at least 10% higher than the sectoral growth or the leadership in that particular sector. Again, let me give you an example. For example, TCS, this is the biggest IT company, not a stock recommendation at all, but I'm taking this as an example here. What do you see here? In the last trailing 12 month, sales growth has been 5%. Profit growth has been 8%. This is the number one IT company. Now you might say that, Rahul, the growth is not there. It's only single digit growth. Please understand that this company's total revenues are standing at a run rate of 2,50,000 crore. It is a massive base, and you cannot expect a 25% sort of a growth in the companies like this. And therefore, if you want to pick up a small cap company from this space, for example, let's say a company that has got 5,000 crores of run rate in terms of the revenues, if you want to pick that company, what are you going to check? You're going to simply go and check the profit growth rate. Here the company has delivered 23% growth in the last 12 months. But if you look at the sales here, it is only 3%. Even if you look at 5-year basis, 4%. Would you invest in this company? I would not practically invest in this company, mainly because the top line is not beating the sectoral growth or the leadership growth, because the whole reason of investing in small cap companies is the growth. And if the growth is not there from a past track perspective, then what is the guarantee it is going to be there in the future? Unless there is a deal pipeline, unless there is a futuristic looking movement in terms of the top line and bottom line, you really do not want to invest in a small cap company that is not even beating the leaders, which are at a very high base. So hope this concept is very clear. Look for a small cap company that is at least growing by more than 10% in terms of the sales and in terms of the earnings growth. With that, let's move to check number 5, which is the liquidity check. Extremely important check that we need to do in small cap stocks. For example, let's say you buy a small cap stock. It has gone up, let's say, by 100%. You're smiling, very happy days. But all of a sudden, the market starts to correct and this stock starts to come down, and you want to now book the profit, sell it off. And what do you find? Every day morning, you go and try to sell it off, but the stock is at the lower circuit. Or there could be another situations where you are not able to sell because you're stuck in a small cap stock, mainly because of liquidity problem. So what is liquidity? Basically, it is the volume that gets traded on the exchange that tells you whether it is easy to buy and sell the stock or not. Now, how to find this liquidity or volume data? Very easy. You can go to NSE website. For example, here, go to NSE website, click on advances and declines. Here you will see the companies that have gained the advance in terms of the pricing as well as decline or unchanged. What you can do is you can download this report here. So for example, if I go to advances here and I simply say download this report here, you can download this report in CSV, right? I have now downloaded this report here, and what you will note here is that I've got the volume as well as the value of the trade that has happened on a particular day. Now simply if you come down here, you are going to note, for example, this company here, again, I don't know the company, not a recommendation at all. You will see that the volume has been only 0.27 lakhs. The total traded value is 1 crore. So if you already had a position of 5 lakh rupees or 2 lakh rupees or whatever, you might find it difficult to sell because buyers are not there in the market. Another example here, the total traded value is only 0.15 crore. Again, these are the traps that you need to avoid. These are the simple basic checks you can go and do. Don't look at only one day of volume. Look at the last 3 days of average volume. These are the things you need to look at when it comes to small cap stocks, because what you don't want to do is get stuck and you're not able to sell. Has it happened to you ever? Let me know in the comments if that has happened with you already, and you will now understand why I'm stressing upon the liquidity check. In this video, so far I've talked about 5 checks. It doesn't mean you only do 5 checks. These are the 5 minimum checks, at least I try to do. And this is what I teach even on my YouTube member community. I share some practical insights, some practical learnings. If you're not yet a member, think about becoming a member, because you're going to learn a lot over a longer period of time. Now, out of these 5 checks, which is the check that you liked the most? Let me know in the comments. Which is the check that you really think is the one that you never knew about? Is it all the 5 checks? One of them? Please let me know in the comments. Your comments motivate me to come up with such content for you at zero cost. Like the video, let me know in the comments a simple thank you. I'm going to see you in my next video. Until then, keep rocking.